Gold, the dollar, and S&P 500 each rising more than 1% in February. In fact, that is something they've done only 3 times together in 5 years. Welcome to Trading Nation. I'm Brian Sullivan. Bill Baruch and Kevin Caron are your guests today of iiTrader and Washington Crossing Advisors. Bill, it's kind of a cool little stat, one of those things you could pop out at a cocktail party. I wonder, does it have any broader meaning, though, for the markets?
I don't think it's very important at the moment, but there are some technicals behind this. Inflation, we've seen it as an uptick there from China last night to data from PPI today. But as well, the dollar, I do question the strength behind the dollar. And I think a lot of the move behind the dollar is weakness overseas, weakness from the euro. I think there's some uncertainty behind the weakness in the euro coming from French elections. And that could cause gold to be attractive. So I think there's a lot of moving parts right now, and I think it's going to work itself out. And some of the technicals where we've seen the dollar index come off of 99.50, where the 100-day moving average was. It broke out from a descending wedge, which is a bullish pattern. On top of that, gold was extremely oversold, and we've seen the dollar in stocks trade very closely hand in hand ever since the fiscal policy and Trump won the election. So a lot of this, I think, is going to work itself out, but I don't think it's a big phenomenon at the moment.
All right, so I'll ask the same question, Kevin, then of you. Kind of an interesting thing. Bill doesn't seem to think it has some broader meaning. What do you think?
It absolutely does have broader meaning fundamentally. So think about what we're talking about. We're talking about stocks, gold, and a dollar. And what they all have in common is that to one extent or another, they're going to reflect changes in inflation. And the other asset, which we didn't talk about, were long-term treasury bonds, which if you look at them together, what you're seeing is that the inflation hedges, if you will, for gold and the dollar, and maybe the equities to a certain extent, those all have risen, and the long-term bond has fallen, which hates inflation. So this is expressing something fundamentally changing in the economy, and I think what it comes down to is that you're deep into a recovery. You're starting to see some tightness in labor markets. You're seeing the output gap, if you will, shrink. And now you're going to hit the economy with a fiscal thrust potentially. And so that's potentially inflationary. And that's playing out perfectly across all of the equity markets, the bond markets, et cetera.
Kevin and Bill, it was a pleasure, and a really interesting sort of historical anomaly. 3 times in 5 years, I think, is a fair characterization for an anomaly. We appreciate your views. Thanks for bringing them to us here on Trading Nation.
Thank you.
Folks, thank you for tuning in. I'm Brian Sullivan. We'll see you next time.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.